The 1920s in America were a decade of unprecedented optimism, often called the Roaring Twenties. Have you ever heard of a time when fortunes vanished overnight? When the world's most powerful economy was brought to its knees? Today, we re-journeying back to a pivotal moment in history. The Wall Street crash of 1929. This isn't just a story about numbers on a stock ticker. It's a human story of ambition, excess, and a painful reckoning that changed the world forever. So buckle up as we uncover what really happened during those fateful days. The 1920s in America were a decade of unprecedented optimism, often called the Roaring Twenties. World War I was over. New technologies like the automobile and radio were transforming daily life, and the economy was booming. It felt like the party would never end. Central to this party was the stock market. Before the 20s, stock investing was mostly for the rich and well-connected, but now it seemed like everyone was getting in on the action. Stories of regular people, shoeshine boys, factory workers, secretaries making fortunes by playing the market were everywhere. This created a powerful sense of FOMO, fear of missing out. People didn't want to be left behind while their neighbors got rich. A dangerous new practice became popular: buying stocks on margin. Imagine you want to buy a $100 stock, but you only have $10. A broker would lend you the other $90. As long as the stock price went up, you were golden. You could sell the stock, pay back the loan, and keep a hefty profit. But what if the price went down? That's where the trouble started. This massive borrowing pumped huge amounts of speculative money into the market, inflating stock prices to unsustainable levels. Companies were valued at far more than they were actually worth. The market had become a bubble, shimmering and beautiful, but dangerously fragile. By the summer of 1929, some cracks started to appear. Industrial production slowed, construction was down, and consumer debt was at an all-time high. A few smart, or perhaps lucky, investors started quietly selling their stocks, sensing that the party was winding down. But for the most part, the optimism continued. Then came autumn. On Thursday, October 24, 1929, the market took a sharp dive. Panic began to set in. This day became known as Black Thursday. To stop the freefall, a group of powerful Wall Street bankers pooled their money to buy up huge blocks of stock, trying to restore confidence. It worked, temporarily. The market stabilized, and for a brief moment, it seemed the crisis was averted. President Hoover even assured the public that the fundamental business of the country is on a sound and prosperous basis. But the calm was short. The weekend gave investors time to think, and what they thought about was how overvalued the market was and how much debt they were in. When the market opened on Monday, the selling started again, but this time it was a torrent. Then came the day that would live in infamy. Tuesday, October 29, 1929, forever known as Black Tuesday. The dam broke, everyone was selling, and almost no one was buying. The stock ticker machines couldn't keep up with the volume of trades, running hours behind. People watched in horror as the value of their life savings evaporated into thin air. A staggering 16 million shares were traded, a record that stood for nearly 40 years. By the end of the day, billions of dollars in wealth had simply vanished. The immediate aftermath was devastating. Those who had bought on margin were wiped out. Brokers made margin calls, demanding investors pay back their loans immediately. When they couldn't, brokers sold their stocks for whatever they could get, pushing prices down even further. It was a vicious downward spiral. Stories, some true and some exaggerated, spread of investors leaping from office windows. While the number of suicides wasn't as high as the legends suggest, the sense of despair was very real. Fortunes built over lifetimes were lost in a matter of hours. But the crash wasn't just a Wall Street problem. It sent shockwaves through the entire American economy. With their savings gone, people stopped spending money. Businesses, seeing their sales plummet, cut production and laid off workers. Banks, which had also invested heavily in the stock market or loaned money to investors, began to fail. When a bank failed, its customers lost all their savings. This created a bank run where panicked citizens rushed to withdraw their money, causing even healthy banks to collapse under the pressure. The crisis quickly went global. American banks demanded repayment of loans they had made to European countries, particularly Germany and Austria, who were still recovering from World War I. This triggered a banking crisis in Europe. Furthermore, as the American economy, the world's largest, contracted, its demand for foreign goods evaporated. This was worsened by protectionist policies. Like the Smoot-Hawley Tariff Act of 1930, which raised taxes on imported goods, leading other countries to retaliate. Global trade ground to a halt. The Wall Street crash had become the catalyst for the Great Depression, the longest and most severe economic downturn in modern history. Unemployment in the US soared to 25%, and in other countries it was even higher. Millions were left homeless and hungry. So, what can we learn from this catastrophe? The first lesson is about the dangers of speculation and herd mentality, when everyone is rushing to buy an asset simply because its price is going up. Without regard for its fundamental value, it's a recipe for disaster. The 1929 crash is a classic example of a speculative bubble bursting. The second lesson is about leverage, or debt. Buying on margin amplified both the gains and the losses. It turned a market correction into a complete collapse. This teaches us to be cautious about borrowing to invest, as it dramatically increases risk. Third, the crash showed the importance of diversification. Many people in the 1920s had their entire life savings in the stock market, sometimes in just a few stocks. When the market crashed, they lost everything. A diversified portfolio spread across different types of assets, like stocks, bonds, and real estate can help cushion the blow during a downturn. Finally, the event highlighted the need for government regulation and a financial safety net. In response to the Depression, the U.S. government created the FDIC to ensure bank deposits, so people wouldn't lose their savings if a bank failed. It also established the SEC to regulate the stock market and prevent the kind of fraud and manipulation that was common in the 1920s. The story of the 1929 crash is a sobering reminder that markets can be irrational and that periods of euphoria are often followed by pain. It's a lesson written in the history books for all of us, reminding us to invest wisely, be aware of risk, and never forget the human cost when financial systems go wrong. It shaped economic policy for generations, and its echoes can still be heard in financial discussions today. Thanks so much for watching. I hope this journey back in time was as fascinating for you as it was for me. If you found this video helpful, please give it a thumbs up and don't forget to subscribe and hit that notification bell so you won't miss our next deep dive into history. See you in the next video.